a little bit of a rebound on markets was quite positive given what we've seen over the past 2 weeks, but traders are a little cautious.
Well, very cautious when the market's down hugely on a Monday, or up on a Monday, down on a Tuesday, and back up nearly over 3% on Wednesday. You need to keep a cool head, and I think a lot of the local market participants are watching the market quite carefully. I think we're seeing a lot of inflows, outflows from foreigners. I think they're dabbling quite a bit in our market, so that's creating a lot of the volatility. So I think our own domestic local traders are taking it easy and just keeping an eye on things more than being very active in the market, I think.
So we're likely to see volatility carrying on for the next 2 or even 3 weeks going forward?
I think the volatility is going to be with us for some time. I think the economic situation, the concerns about Europe, and after Greece and after Spain, and there'll be something else down the line to worry about. So I think the volatility will stay with us. But I still think overall we're still seeing positive growth coming forward, and that should win out the day, I think, at the end of the day.
Okay, going forward, we know that growth is going to be the main concern given what's happening in the Eurozone, but we know that emerging market economies are going to be outpacing developing nations. The OECD raised its growth forecast for China and India. China is going to grow about 11% and India at 8.3% in 2010, despite overheating in those economies. And then we've got the global growth at 4.6% for this year.
Yes, that's our own forecast for global growth, also 4.6%. We saw the IMF up their numbers in April to 4.3%, and looking for similar numbers in 2011, also in the fours, around 4.5 or so. So that's quite positive, and I think we're seeing, even the developing America's growing quite strongly, looking for 3.5% there, Japan 3.5%, and as you said, China and India. There were concerns now with Europe, with them slowing down, how that would impact on the other economies like China, for example. But there again, they're looking to take their foot off the pedal a bit and increase interest rates in China. But I think they're watching the rest of the world, looking how that growth pans out and adjusting their foot on that pedal as they need to.
Here in South Africa, CPI better than expected yesterday, following on the better than expected GDP out the day before. A pretty good picture all around here.
This is just what you would want to see. Growth better than expected and inflation lower than expected. So that picture is looking quite good. But what we need to see now, the GDP number was boosted by mining and manufacturing, the production side of the economy. We need to see all the interest rates now doing their work and the consumption side of the economy picking up. We need to see the consumers and the households in a better place. And that part of the economy is what we need to drive us and the future growth going forward. So that's what we want to see coming through now.
Households still under pressure. Could we say could we get perhaps one last interest rate cut?
I still don't think so. I think we're going to see flat rates for some time into 2011, the first half of 2011. So we could still have quite a loose, relaxed monetary policy for some time. But I don't think another rate cut's on the cards.
Going back to CPI, there was a month-on-month increase of 0.2%, but that was largely due to the petrol price increase of 6.1% there. But inflationary pressures seem to be at bay at this stage.
Yes, and we saw the Reserve Bank looking at their window to the end of, I think they're going into 2012 now, and looking for inflation to stay in the target band over that forecast period. So that's quite positive. They did point to, in their estimations, a low point of about 4.7. So we got to the 4.8 yesterday. So I think we're near that bottom. But the outlook's not for CPI to run away from here, but to stay sort of around the 5 mark for the next year or so.
But the risks to CPI are the wage settlements that we're seeing at the moment. We had one Transnet union looking for accepting about 11% and another one holding out for about 15%. And then we have Eskom threatening to go on strike looking for 18%. But we're not seeing much productivity. If we're seeing much productivity at the same time, then we wouldn't have to worry about economic growth going forward as well as inflation.
It's certainly one of the risks to the inflation number. I think you have to look at the percentage of wages in the overall CPI basket and the impact of that. But we don't want to see these big wage increases that are even twice the top of the target range. As you say, without any commensurate productivity increases, they are just inflationary. So that is one of the risks, along with all the other administered price risks, electricity and all those stories we know about.
Okay, we've got PPI later out today. What are your expectations on that front?
Yes, it's been on an upward trend. We've come from deflation, it's turned positive, and it is on an upward trend. We're seeing a lot of the commodity prices and all that playing a big part in pushing that up. and it will likely go up again today, probably above the CPI rate now.
Okay, well, corporate results out, Mr. Price out with pretty good results given the current climate that we find ourselves in.
An excellent result from Mr. Price, and I think the market liked it. Also upping their dividend, reducing their dividend cover. That was quite a positive out of that. But 84% of their sales are cash sales, so they're not a credit retailer by and large. So benefiting there from their nearly 4 million customer base, and I think they've just got it right. The value proposition that they've got in that fashion space just seems to do the trick, and they're attracting a lot of new customers and increasing their market share. So a very good story from Mr. Price yesterday.